Hi, welcome back. I want to spend some time talking about something called a safe withdrawal rate. And basically what the safe withdrawal rate is how much money that you're allowed to take out of your accounts hopefully without running out of money. There was a study done years ago, back in I believe around 2000 by AARP, that said that 4% was the amount of money that you could take out of your accounts, and statistically you shouldn't run out of money during your lifetime. Well, if we think about that, back in the year 2000, we had just made it through the 90s. And the 90s were, I know a lot of you are thinking, were probably some of the best years that the stock market has ever had. Well, if you're thinking that, you're right. The stock market in those years was averaging around 14% per year. As a matter of fact, even bonds back then were averaging around 6% per year. Well, back in 2000, that study was put out, I believe it was, that said 4% is how much you could take out of your accounts. So if you have $1 million portfolio, that would mean that you could pull out about $40,000 per year out of that account. And statistically speaking, you have about a 90% success rate. So you shouldn't run out of money if you're doing that. Now, this study was done on a 60-40 split, which means you're using 60% stocks, maybe 40% bonds. Well, let's fast forward to today. Is the stock market still averaging 14%? I wish it was. The stock market now is averaging right around 8%. So pretty different than a 14% per year average. And bonds today are averaging around 3%. So about half of what they were back in 2000. Well, would you think that we could still take 4% out of that account per year? Probably not. As a matter of fact, Wall Street Journal put out a study, it's been a few months back, maybe a year ago now, that said that a safe withdrawal rate at this point is around 2 to 3%. So think about that. If you have $1 million portfolio, let's say you've worked your entire year, you've put money away every single month from your paycheck, and now you've accumulated this nice nest egg. You've got maybe $1 million saved up. Well, you're going to move into retirement, and what that study tells us is we could take somewhere between $20,000 and $30,000 a year out of that account. That's probably not going to excite a whole lot of you, and it shouldn't. It wouldn't really excite me either. There's still ways that you can achieve a 4 to 5, maybe even 6% withdrawal rate, but it's not using that old 60-40 split that maybe your mom and dad used to, or maybe when I'm speaking, it was my grandparents that used that. Today, investment strategies, tools, objectives are very, very different than they were back in 2000. So your investments must evolve with the times. You could still try that stock and bond strategy, and it may work. But statistically speaking, 2 to 3% is all you could really take out of that account and not run yourself out of money. So we talk a lot at our firm about something called the Rule of 100. Now, we work primarily with those that are retired or within about 10 years of retirement. So really this is what our firm is based around, is generating income plans that our clients can pretty much bank on. They know what it's going to be for their lifetime. There's a little bit of fluctuation, but it's not going to be nearly what the stock market would be. So what that means is, what the Rule of 100 is whatever your age is, you take that from the number 100, and that would be the percentage of your assets that you want to be in a very safe and protected environment, getting guaranteed results year after year after year. Then, if you're comfortable with risk, then with the balance of that portfolio, that's where you can go out and take a little bit of risk. So let's think about that. Let's say that we have that same couple, and they've saved $1 million in their portfolio, and now they're, let's say, 65 years old. Well, that would mean 65% or $650,000 of their portfolio they would want to have in something that's safe and protected and guaranteed, getting income that's going to last as long as they need it to. Now, there's some companies out there that will even offer up to a 6% guarantee. So 6%, I mean, if you think about that on a $650,000 portfolio, that's over the 2 to 3% withdrawal on the $1 million. And you've still got $350 left. So 6% on $650,000 is $39,000 per year. Then with the balance, that other $350,000, now you can go out and play with a little bit of stock market risk and maybe use some of those 3% bonds that we were talking about a while ago, or maybe try to go after those 8% returns that the stock market is averaging. So if you're nearing retirement, if you're within 10 years or so of your retirement, and you're thinking, well, I'll just use that 60-40 rule that mom and dad talked about, things have changed today. it's time to reach out and talk to someone that specializes in retirement planning. Give us a call at our office and we'd be happy to talk with you about how to structure your portfolio to transition over into your retirement years. We look forward to hearing from you.